Hey, what's going on, everyone? Welcome to another video. Today, I'm going to be talking about an extremely simple option trading strategy that will allow you to produce income on a weekly basis, monthly basis, and is super friendly for actually small accounts. I'll walk through 3 examples today, and if I have enough time, I may throw in a bonus fourth example in the end, so stay tuned in case you want to see that fourth example. And if you found value at the end of the video, it'd be amazing if you could like, subscribe, and also feel free to comment down below any stocks or option strategies you want me to cover. And also there's a couple amazing resources linked in the description below, so feel free to check those out. And note, today's Tuesday, July 18th. The market just closed, so keep that in mind as we go through some of these examples, as it could impact some of the option premiums. And if you're new to the channel, or if you're new to option trading, then that's amazing. In this channel, I really focus on easy, simple examples that you could utilize to create, that weekly, monthly passive income. So I'll quickly walk through how to do the trades, what they look like, strike prices to look at, what kind of premium you can expect to earn. And I'm going to be doing it on the Robinhood platform, just given the user interface, in my opinion, is really easy to understand and grasp. So in Robinhood, I'm going to start off with AMD. AMD has been covered many times in this channel. I love AMD. I love trading options on AMD, and especially love selling options on AMD. So what's going to happen here is in Robinhood, I'm going to click Trade Options on the far right-hand side. And now it's going to take you to this page. And a few things need to happen for the strategy that I'm going to cover. I'm going to cover the put credit spread. I've covered this many times, and I think it's an amazing strategy. It's super simplistic, and it's awesome for you to create passive income if you have small accounts. If you have larger accounts and you're willing to purchase, 100 shares, you could sell cash secured puts, which I've covered in other videos, so check those out on the channel. For the put credit spread, what are you going to do? You're going to change the expiration first. So I'm going to go to August 18th, about 30 days out. I like to trade about 1 month out, given you can capture the most premium, and theta decay will start to maximize. Next, what you need to do is you need to go to put, so put credit spread. So it's going to consist of 2 option legs. So I'm going to go to put, I'm going to go to sell, and what it's going to look like, it's going to look like you're selling a cash secured put up front. So let's look at AMD. AMD had a run up and then it came back down. It's kind of stabilized. So I'm going to go a bit aggressive, and I'm going to go with the 110 put. And this is just going to be an example. And then I'm going to go buy. And now I need to buy one leg lower. So now I'm buying one leg lower. And you can see here the expected profit is $135. Credit up here is 126. That's just because it's after hours. So the bid-ask spread is a little off. So effectively, it'll be about $125 is the amount of premium or credit that will be in your account today if you did this trade. And you may be asking, how much am I putting at risk? So what you're putting at risk is $500. So in one contract, in one option contract, there are 100 shares. So you're selling a put, so you're selling one option, and then you're buying one option. So the difference between these two is the credit, and the difference between these two strike prices is the spread, and that's effectively $500. So 5-point spread, you're risking $500. So if you think about it from an ROI standpoint, you're getting $125 roughly. That's over a 20% return in 31 days. Now, that's assuming this option expires worthless. So this could be a little bit aggressive if you think about it from that lens. And you may be thinking, well, I don't want to be that aggressive. I want to be more conservative. That's totally fine. Let's look at a couple option legs lower. So let's go all the way down to the 100. So fairly low, 20 points lower almost from where it's trading today, a delta of 0.11. So that means it has about an 11% chance of expiring in the money. Implied volatility is pretty solid, 52%. That's good. The higher the implied volatility, the higher the option premium is going to be. So you select the 110 for the sell. Now let's switch to buy. We're going to go one leg lower, just like we did previously. And now you can see the total credit is roughly $47, $50. So you're putting up $500 of collateral because $5 spread between 100 of the put you're selling and 95 of the put you're buying. So that's roughly a 10% return in 30 days. So for moving the option almost 10 points lower from where we were before and doing the put credit spread, you can still get a 10% return. And the key question you have to ask is do you think AMD is going to drop 17 points in the next 30 days, or do you think it has this amazing momentum given Gen AI, chip demand, and whatnot? If NVIDIA's chart and momentum over the past couple of months isn't an indicator of where AMD potentially has the ability to move, I'm not saying it's going to go to 400, but I think it has that amazing momentum given it's in the same space as NVIDIA. That's the perspective I would have on AMD. The put credit spread is bullish, so keep that in mind. It's more of an income bullish strategy. Now for the second example is Palantir. So Palantir does have earnings coming up. I think it's in August, early August. Yep, August 7th. So keep that in mind. You want to be a little careful and sensitive when you're looking at options and selling options around earnings. You want to make sure you have enough time after earnings so that in case the stock swings in the wrong direction, it could recover potentially. So as you can see here, in the 1 month, Palantir has had this forward amazing momentum. Looking at the 3 month, even better. In 3 months, it's up 100%. So for Palantir, I'm going to assume it still has that bullish momentum. There's a lot of opportunity for it to run, a lot of opportunity in this space. So let's take a look at the put credit spread, and maybe we can be a little bit more conservative given the run up it's had. It's pretty significant. Let's take a look here at the 15 strike, delta 0.17, so roughly 17% chance it'll expire in the money. That's almost 3 points lower from where it's currently trading, so pretty significant drop would have to happen. I think that may be almost 20%, but implied volatility is 81%, so pretty high, so that means it's really helping out the premiums. So I'm going to select this 15, and I'm going to buy a leg lower. So as you can see here, the leg lower here is actually a $1 increment, so the amount of capital you're putting up for risk is $100. So if you want to do 5 options, that could be $500. So you would have to sell 5 puts and then buy 5 puts. And here in this example, you would collect $17 roughly for putting up 100. So that's a 17% return. So pretty significant. If you did 10 of these, so 10 put credit spreads on these strike prices, it would be roughly $170 over $1,000 of collateral. So again, still a 17% return, but you have to determine how much collateral you want to put up at risk. Now, if you want to be a little more conservative, let's take a look at a lower strike price. And you'll see here, once you choose these lower strike prices, you actually won't get that much of an ROI. So here you're going to get roughly a 5% return, which is pretty minimal in my opinion, but still pretty solid. So I guess the key question you have to ask is, do you think Palantir is going to go down below $13 in the next month? So you have to decide that for yourself to determine what strike prices make sense depending on the premium you're looking to achieve. Now for the third example, I'm actually going to cover Delta Airlines. So Delta Airlines is a bit different industry than I would typically cover for selling options, but I think there's a lot of momentum given the recent earnings came out, exceeded expectations. They've been doing phenomenal. As you can see here, recently exceeded expectations for earnings. And going into the summer months, I think there's a lot of opportunity for Delta to continue to run up. So let's take a look at some put credit spreads. I don't think the premiums are going to be as good as some of the other tech stocks, but it's always good to diversify. So I'm going to take a look at 45. So if I sell a put for 45, I would collect $47, and then if I buy put a leg lower, and I could do $1 increments, I'm going to go down to 40 to kind of protect myself, to hedge a little bit. The total credit I would receive is $36 for putting up $500 of collateral. So here in this example, it's roughly 6-7%, not quite 10%, but pretty significant from a monthly standpoint. So if you annualize that, it's over 60-70% return, which is phenomenal. But you have to determine, where do you think Delta is going to go in the short term? Do you think Delta is going to continue upward, stay neutral, or decrease over the near term? Now, if you're super bullish and you want to be a little bit more aggressive, I'll show you what the premium will look like if you're way more aggressive and go, let's say, at 48 and 47. So here you're putting up $100 of collateral. you would get $33. So it's a 33% return in 1 month. Again, this is super aggressive, and there's definitely a chance Delta can come back down, consolidate a little, and putting up $100 of collateral to gain, 33. So from an ROI standpoint, that's not too bad in that sense. It's 1/3 return almost on your investment in a month, but there's a significant risk of that collateral being taken away and Delta being below $48. So keep that in mind when you're trying to figure out what premiums and strike prices you want to trade for the put credit spread strategy. Now, the last stock I want to cover is the bonus stock, stock number 4, Disney. And I know I covered Disney in a recent video, but I think it's more apparent and relevant given the latest news about the old CEO coming back in and renewing his contract until 2026. So what's interesting here is when that news was released a couple weeks back, since then, the stock has actually come down a little bit more. So to me, it's an opportunity to capitalize on the stock's decrease, even though long term, I actually am way more bullish on Disney. So what can you do given that situation? So with those assumptions, I'm bullish. I'm going to look at the put credit spread strategy on Disney. And again, I don't think these returns or premiums are going to be as amazing compared to tech stocks, for example, but I'm going to maximize on this opportunity potentially. So let's take a look at the 80. So I'm going to sell an 80, and then I'm going to buy one leg lower. So I'm going to buy the 75. So I'm going to receive a total credit of $64. So that's about a 10% return, a little bit more than 10% return in 1 month time frame. So I'm definitely assuming Disney is going to recover. I hope you enjoyed the video. I hope you enjoyed the examples. If you're new, I would love it if you could like and subscribe. And feel free to comment down below any stocks you want me to cover or any questions you may have. Hope you have an awesome one, and I will talk to you in the next video.